The market reaction to these escalating trade tensions was immediate and severe. On April 3rd, just one day after Trump's tariff announcement, the Dow Jones Industrial Average plunged nearly 1,700 points, its worst single-day performance since March 2020, when the COVID-19 pandemic first sent markets into freefall. To put this in perspective, this represents a decline of approximately 10% from its February peak, wiping out billions in market value in just hours. The carnage wasn't limited to the Dow. The S&P 500 dropped 4.84%, while the tech-heavy Nasdaq fell a staggering 5.97% in a single trading session. By April 7th, the situation had deteriorated further. The S&P 500 had fallen almost 6% for the week, marking its worst weekly performance since the height of the COVID crash. The Dow was down 5.5% for the week, and the Nasdaq dropped 5.8%, officially entering bear market territory, defined as a drop of 20% or more from recent highs. The selling pressure was relentless. Trading floors around the world were scenes of panic as investors rushed to reduce exposure to what many feared could become a prolonged global trade war. Market circuit breakers, designed to halt trading temporarily during extreme volatility, were triggered multiple times, providing only brief pauses in the downward spiral. This wasn't just an American phenomenon. Global markets also experienced significant declines as investors worldwide recognized the threat to global commerce. The UK's FTSE 100 fell almost 5%, its steepest decline in 5 years. France's CAC 40 dropped 4.3%, Germany's DAX fell nearly 5%, and Japan's Nikkei 225 decreased by 2.7%. Even commodities weren't spared, with Brent crude oil dropping 6% as traders priced in reduced global economic activity. The volatility index, often referred to as the market's fear gauge, spiked to levels not seen since the early days of the pandemic. Bond yields plummeted as investors sought the relative safety of government securities, with the 10-year Treasury yield experiencing its largest one-day drop in years. Specific sectors and companies were hit particularly hard, with those most exposed to international trade suffering the deepest losses. Tech stocks, which are especially vulnerable to trade disruptions with China, saw dramatic declines. Apple, with its significant manufacturing presence in China, fell over 9%, its steepest intraday decline since early 2019. This single-day move represented more than $200 billion in market capitalization evaporating. Boeing tumbled 10% as investors feared disruptions to its global supply chain and potential retaliatory measures targeting American aerospace. The company, already struggling with various challenges in recent years, now faced a new threat to its recovery prospects. The automotive sector, with its complex international supply networks, also suffered severely. Major manufacturers like General Motors fell 8.3%, Ford dropped 7.5%, and Stellantis declined 9.2% as analysts calculated the potential impact of tariffs on their intricate cross-border supply chains. The modern automobile contains thousands of components sourced from dozens of countries, making car manufacturers particularly vulnerable to trade disruptions. Semiconductor companies, whose products flow across borders multiple times during the manufacturing process, were among the hardest hit. Nvidia dropped 11.2%, AMD fell 10.3%, and Texas Instruments declined 7.8%. These companies not only rely on global supply chains, but also count China as a major market, creating a double vulnerability to trade tensions. Financial stocks weren't immune either. Major banks with significant international operations saw their shares tumble as investors worried about exposure to trade-dependent companies and the broader economic impact. Goldman Sachs fell 6.9%, JP Morgan Chase dropped 5.8%, and Citigroup declined 7.1%. The retail sector also faced significant pressure. Companies like Walmart, Target, and Best Buy rely heavily on imported goods, particularly from China. Their shares fell 4.7%, 5.3%, and 8.1% respectively as investors calculated the potential impact of tariffs on their cost structures and profit margins. Energy markets reacted swiftly to the news of tariffs on Canadian imports, with gasoline prices in the northeast United States already up 40 cents per gallon by mid-March, adding further pressure to consumers already facing inflation concerns. The tariffs on Canadian energy imports were particularly impactful, as Canada supplies approximately 4.3 million barrels of oil per day to the United States, accounting for roughly 61% of all U.S. crude oil imports. The market collapse wasn't simply a matter of stock prices. The real economic implications began to manifest immediately. Companies across sectors announced freezes on capital expenditure plans, citing uncertainty about the trade environment. Hiring plans were put on hold, and some firms began preparations for potential layoffs if the situation continued to deteriorate. Consumer confidence, which had been relatively strong, showed signs of eroding as Americans worried about higher prices and potential job impacts. The University of Michigan Consumer Sentiment Index recorded its largest two-week drop since the beginning of the pandemic. Business confidence similarly plummeted. The Business Roundtable CEO Economic Outlook Index fell sharply, with executives expressing concern about the combined impact of tariffs, retaliatory measures, and overall economic uncertainty on their operations and forward planning. Bond markets flashed warning signs as the yield curve inverted more deeply, historically a reliable predictor of economic recession. Credit spreads widened as investors demanded higher returns for taking on corporate debt, effectively raising borrowing costs for businesses at a time when many were already feeling financial strain. The currency markets experienced their own turmoil. The dollar initially strengthened against most major currencies as investors sought safe havens, but then weakened against the Japanese yen and Swiss franc, traditional refugees during times of market stress. The euro fluctuated wildly as traders attempted to calculate the relative impact of trade tensions on different economic blocs. Gold, often considered a store of value during economic uncertainty, saw its price surge over 3% in a single day as investors sought alternatives to equities and currencies. Bitcoin and other cryptocurrencies experienced extreme volatility, with initial sharp declines followed by significant recoveries as different investor narratives competed for dominance. For ordinary Americans, the market collapse had immediate psychological impact. Retirement accounts and college savings plans heavily invested in equities saw significant value erosion. Financial advisors' phones rang constantly as worried clients sought reassurance and guidance amid the market turbulence. The market reaction was not merely about the current tariffs, but fears of what might come next. Would China retaliate beyond currency devaluation? Would other countries be drawn into the conflict? Could this escalate into a full-blown global trade war reminiscent of the destructive protectionist spiral of the 1930s? These questions haunted trading floors and investment committees worldwide. Economic forecasters rushed to update their projections. Goldman Sachs revised its U.S. GDP growth forecast for 2025 down from 2.5% to 1.7%. Morgan Stanley cut its target for the S&P 500 by 12%. Deutsche Bank raised its recession probability from 35% to 55% for the coming 12 months. The Federal Reserve, already navigating a complex monetary policy environment, now faced additional challenges. Market participants began speculating about how the central bank might respond to the combination of higher inflation from tariffs and slower growth from trade disruption, the dreaded stagflation, scenario that presents particular difficulties for monetary policy.